What if you had a portfolio that only followed the risk-on portion of the 12% solution? In other words, expand the risk-on portion from 60% to 100% of the portfolio. What kind of returns could you expect, assuming that you could stand the volatility? As readers of the book know, the strategy in its pure form splits the portfolio into 60-40. That's 60% in equity or risk-on assets, and a 40% bond hedge to help smooth out the ride and protect during those downturns. As a rotation model, those risk-on assets might change monthly, as might the bond fund. But the proportion, 60-40, that remains the same month after month. Now, we've had a number of investors over the years wonder what the performance would be like if they just scrapped the hedge and expanded the equity portion to fill the entire portfolio. As you might imagine, the risk to the portfolio does go up. But because the equity portfolio comes with a built-in cash trigger, that risk might not be as much as you would think. Let's go ahead and run some numbers. First, the strategy in its pure form, the 60-40 model. Backtesting from 2008 to 2021, the last full year before this video is made, we get the following results. Next, let's look at dropping the 40% hedge and just going all in with the equity ETFs. If we don't employ the cash trigger, we get the following results. Now finally, let's go ahead and drop the 40% hedge, go all in with equity ETFs, but this time we will employ the cash trigger mechanism, which gets us completely out of equities when the going gets tough. Here are the results. As a side note, without the cash trigger, only 3 years underperformed the market out of 14, and then only slightly. Of course, it follows SPY right down the toilet in 2008 to 2009. With the cash trigger, 5 years underperform. But protection is in place for larger corrections. Here's the bottom line. We believe the best approach from a risk-reward perspective is to follow the strategy in its pure form. But for those investors who have a greater tolerance for risk, dropping the hedge does have the potential to boost returns over the longer term. As a trade-off, it will mean weathering more volatility and steeper drawdowns. But employing the cash trigger will help to keep those drawdowns in check. As a reminder, the 12% solution is a do-it-yourself strategy, and the entire system, including the cash trigger, is fully outlined in the book by the same name. Click on the link in the description below and pick up the book on Amazon. Thanks for your questions, and thanks for watching.